And on the other end of it, it's really exciting for us that Scale and those firms are there to help continue to finance our companies that are successful through the Series A period.
I mean, I think the things that you point out there are really important because we've been talking mostly about financial allocation, check size, and sort of outcomes and exit targets. But I think starting with Bill Gross in late 90s, I think he pioneered sort of some initial incubation concepts, and I think he gets an unfair rap on sort of the performance there because some of those ideas, some of those companies ended up being billion-dollar companies. GoTo was acquired eventually by Yahoo. It became the fundamentals of a lot of their search monetization, which was a billion-dollar deal. And performance of his fund wasn't so great in the latter one, although the previous one was great. More recently, Paul Graham, I think, with Y Combinator, and then later Techstars and a bunch of other people started pioneering this concept of incubators. And I think that's something that we're also trying to do. We have a 10,000 square foot facility in Mountain View, so we're not just a seed fund, we're also an incubation facility for some of our companies. But whether or not you have an incubator, I think there is a reversion to investing in the 70s and 80s, which is operational folks are now becoming the predominant investors, I think. There's still lots of people with MBA and finance backgrounds, and in the later stages of investing that is important, but I think originally a lot of the investors that came out of venture capital were people that came out of chip companies and to some extent software and hardware companies. And they had sales experience, and in some cases operational experience in those industries. For a period, I think in the 90s, it became more popular to just be a finance person and be throwing money at the industry. And I think what you've seen in the last 5 years is a reversion to operators who come out of either product, engineering, design, that's emerging, and marketing and sales backgrounds. Because in the early stages of building these companies, that's the expertise that you want. You want to understand product development issues, you want to understand design and UX issues, you want to understand marketing and sales and distribution issues. And scaling the company and financial accounting management probably starts kicking in really more around Series B. And so I think there's different skill sets that are being applied in both incubation, angel, seed, Series A, and Series B. And that's really become a differentiating factor for how we work together, is that there's different skills that are brought in when the company's first being started, and then as it scales up, there's much organization growing and other types of skills that are needed.
Yeah, I think one of the others, so if you just think about what's changed, it always depends on what you pick as your change point, but let's pick 2008 for this example. Completely agree that so entrepreneurship and the number of new ideas that come is completely independent of the NASDAQ. So lots and lots of great ideas come, and the awesome thing right now about the emergence of angel and super angel is that a lot of them are getting funded. What's really different about 2011 versus 2008 is that what was always billed as the sucker round, the Series B is the sucker round, okay? Because
I thought we were the sucker round.
Because there was somebody smart money who did a Series A, and a friend would do the Series B, even though the company didn't really have traction. It had a lot of promise. It had a beta, it had some happy beta customers, didn't really have traction. Those rounds don't happen as much anymore. Some of them do when it's a really, really gold-plated investor list or a really awesome
entrepreneur list.
Is DST the typical investor at that stage, or DAG was?
Well, yeah. I mean, let's just say DAG.
Those guys are doing actually pretty well, though, I think.
But the thing that's different is, and actually I have an interview on this very topic coming up next, which is the Me Too companies. So it used to be meaning 2006, 2007. If you had a pretty successful company, meaning you had a company that was doing $10 or $20 million in revenue, it was having to just knife fight in the street for every customer deal, because there would be another 10 or 20 venture-backed companies that got manufactured because that one was successful. I mean, and see, this is happening for Groupon, where there's literally over 120 Groupon clones, but Groupon seems to be able to power through all of them. But people are they want a little piece of that, and so they fund That's where some of that $30 billion was going. We're funding the Me Too companies. I mean, I have a friend who's an entrepreneur.
Color is
who-
an example of that, right?
Huh?
Color would be an example of that. Lots of photo sharing companies. that-
Yeah, there's a ton of photo sharing companies, so why should that one get $40 million in its first round? You know, and here's just an apocryphal story. This is when you know it's like time to back off from investing. This happened in 2007. Founder of one of my companies founded another company that had, in my mind, no real business model in mind, but it was going to be a way of sharing lots of content and interest. And he raised money from a small second string venture fund who, when those guys called me to do a reference on him, their East Coast fund, they said, I don't really understand what UMon is doing, but I want to get some of that Web 2.0 stuff. That's when you go like, you know, like, stop investing now, I want to get some of that Web 2.0 stuff, right? That's
there's
how
part of that that
VCs
does-
raised $30 billion.
But there's part of that that I think is really interesting, and here's the next tectonic shift that I think is going to start happening. I think that, at least from my perspective, the acquirers of our companies are not going to be as much Google, Microsoft, Yahoo, or even Facebook and Amazon. I think they're going to be P&G, Nike.
I talked to them yesterday,
You know, right. So what's happened? So remember, I was talking about all those distribution changes. Like everybody is online. Your mom, your kids, your grandmother. My 90-year-old grandmother. My wife's 90-year-old grandmother in Tokyo is online looking at pictures of our kids. Right?
I'm going to bring it back down to the micro
Wait,
level
I
again.
just want to talk about the
Okay,
distribution changes.
okay. And so what?
These companies are going to
what
start
could-
buying
could-
technology. The
I'm-
reason they want Web
I'm-
2.0.
I'm with
Hey,
you.
hey,
Corporate buyers are out there, and I agree.
Right.
But
Non-technology company.
from an entrepreneur standpoint, though, you know, you just heard the panel saying, you know, what's really important. Well, you know, once you break 5 million in revenue or 10 million in revenue, there's a lot of people that want to do business with you. We get calls on, you know, weekly, monthly basis from East West Coast firms, because when we started, we weren't going to be beholden to Austin Ventures. They are a great firm. We've syndicated with them. I love those guys. They're great. But we made an effort to reach out to VCs across the country, and we've been doing that ever since. So once your company gets past $5 million or whatever the key milestone is, there's a lot of interest out there to help you build your company into a great business. And so what we focus on is wrapping our arms around you. We don't spray and pray. We don't make 500 investments. We make, you know, 2 to 4 a year, and we put our money and time and effort behind them. We build them up, and we get them to that next level. And that's why we are successful in getting either great partners to fund with us, or we sell them to strategic corporate buyers. Now, the tectonic shift that I think is going to happen is that what you're seeing with Facebook in secondary markets is not going to go away. I think the whole secondary market piece that's been around for a long time in the Valley. You know, founders have been able to sell their shares, you know, sort of to friends or different people. Right. And so, you know, there's a new tectonic shift that's coming along that's going to be wrapped around secondary markets, and entrepreneurs that have been in their companies for, you know, 3 to 5 years and taken big money and are looking for big exits, they are going to be able to find places where they can monetize the equity and hard work they put into their companies. So that'd be my
Potentially even to the point where they don't have to sell. Like, I think that's the other opportunity is, I think you hit it on the head. 5 million is the magic number, I think. Probably I'd say $1 million in profit and 5 million in revenue. People start calling you. And the interesting thing is they'll want to, VCs will want to fund you at the level, have you do the B round or even later. Companies will want to acquire you, but I think in the future, second market and other people will figure out ways to find liquidity for you, one way or another, and you can do the keep running your company flip, right? Which is you can get liquidity not necessarily from VCs, but from the market, and keep running your business, which is awesome, right? That's what's totally awesome. Is that as an entrepreneur, you can build your company for probably $1 million. You can get distribution for probably $1 million. And then if you get to 5 million in revenue and 1 million in profit, probably a little bit larger right now, then you can probably get liquidity, right? Through a number of means. And if it's really magical, this will probably be in 5 years, you can keep running the business and get that liquidity.
Let me,
I actually just worked on an investment. I just worked on an investment. This is a deal I just love. So it's
Quick
a
example.
e-commerce company on the East Coast that never took any venture capital money, The two founders own it, and it's doing well over $500 million in revenue this year. It's been profitable.
500?
Yes, yeah, I mean, yeah, I don't wanna say the number because I've signed a non-disclosure, but it's well over. And they're really, really smart guys. And now they're going to do a recap with some private equity firms, so sell a quarter of the company, take home possibly hundreds of millions of dollars in equity and still own a majority of the company, you know?
Tanker.
And they own it. I mean, they, you know,
I
they,
think
you
that
just,
deal gets
that,
done at 1/10 that size that you were just describing.